Do you know why most of the banks insist on a minimum current ratio of 1.33? The logic is simple. Just look at this. I'm going to give some numbers here. If my current asset, let's say it is 100 million and current liabilities are 75 million, what happens here? 100 million of current assets were funded by 75 million of current liabilities. So question arises, who funded the balance 25 million? Balance 25 million, which is nothing but the difference between current asset and current liability, is funded by long-term funds. Technically, we call it as net working capital. So when your scenario is like this, if you calculate current ratio, that is 100 divided by 75, you will get the current ratio as 1.33, which ensures there is a long-term funds of 25 million. In our case, it is 25%. Long-term fund of 25% has come in to fund the current asset. That is very important. If current assets are fully funded by current liability, that business will struggle. If current assets are supported by long-term funds in the form of net working capital, and if at least 25% comes in the form of long-term funds, then that business will have manageable liquidity position. That's why most of the banks insist on current ratio of 1.33. 1.33 means 25% long-term fund contribution for build-up of current assets.